Hello and thanks for checking out ChartGuys.com. We're proud to be one of the most successful technical analysis communities online, teaching you the skills to become a more confident, effective, and informed trader. Join our community of hundreds of analysts worldwide working together to learn the charts, generate profit, and achieve financial independence. For access to daily live chart analysis and market coverage, a thriving chat community, along with dozens of hours of exclusive educational materials. We look forward to seeing you. Let's check out some charts. Hey everyone, in this video we're going to be going over how to move from trading cryptocurrencies into trading stocks. And when I started making this video, the cryptocurrency space was very slow. There was not a whole lot of opportunity. And of course, as I'm recording this now at the end of October 2019, we just had a 40% move in Bitcoin and that opportunity is back again. So I want to be very clear, this is not a video of me saying you should be trading stocks and not trading cryptocurrency. The goal of this video is to give knowledge to empower people to have the comfortability and the incentive to know how to trade different markets for when different opportunities arise. I will probably never repeat this again in my life in terms of the opportunity that there was in 2017 into 2018, but after making 3,000 to 3,500% gains in cryptocurrency, I emptied 2/3 of my cryptocurrency account, saw the opportunity that was presenting itself in the Canadian marijuana space, and then doubled those profits in the Canadian marijuana space. The ability to compound those gains would not be possible if I was stuck in one sector or in one trading environment. So this is just allowing you to move around. The agility as a trader to jump on opportunities as they arise is essential. So we're going to be talking about the pros and cons of trading stocks versus cryptocurrencies, as well as their similarities, the different brokers that we can use to trade stocks, important aspects that we need to be aware of, what is margin? What is pattern day trading? Trader tax status? We'll answer all those questions. And then we'll wrap it up with some questions from Chart Guys members that I will answer. So first things first, pros of stocks. Why would we want to move to stocks over the cryptocurrency space? The most obvious one and biggest reason for me is the fees. We now have zero trading fees in the US. This is a very recent development. It's been a slow race to the bottom over the last few years where we've gone from $9 a trade to $7 to $5. And then we just went pretty much from 5 to 0. And that's due to competition between these brokers. And this will happen in the cryptocurrency space as well. The first cryptocurrency exchange that goes to a flat rate fee rather than percentage based is definitely going to see big money flock to that exchange. The reason being, if you have a small account, the percentage based fees are great. And the reason is because a flat fixed, $7 per trade could potentially be a significant amount of your capital if you're trading with $1,000 or less. Otherwise, if you are trading with significant money, you want a flat based fee, because it is possible to rack up thousands of dollars. There have been plenty of times in the crypto space where I've done a market buy and a market sell if there has been fast moving action, and that's racked up 4 figures in fees. And back when we had fees in the stock world, that would literally be 300 plus trades for me to match that size of fees. So we are now going to be watching for the race to be on between the exchanges in the cryptocurrency space. But again, that may take years and years to play out. The other thing to be aware of is that this is just in the US right now. Canada still has fees. Europe still has fees. So this is going to put pressure on other brokers to lower their fees as well. But just be aware that based on where you are living, it's going to determine your access to brokers that either have free trading or that still have fees at this point. The other biggest factor is dollar volume, liquidity, and opportunity with the sheer amount of trading instruments. So first, let's talk dollar volume. When things get slow in the cryptocurrency space, if you were to market buy $100,000, you would move the price significantly enough to see your wick on the candle. You then would see the bot step in and fix that price adjustment, but you would affect the markets with that $100,000 order. If you look at the dollar volume on any of the major stocks, and I don't have the aggregate total of what the S&P 500 trades in a given day, but you can look at one name like Netflix or Apple. They trade $4 to $6 billion a day. That is so massive compared to the cryptocurrency space. It is hard to even fathom. So I can market buy $1 million on Apple and the price will move maybe 10 cents or so. And it's just not a ton of slippage at all. And again, just going back to the fees, if we have a flat based fee, I could market buy $10 million for $5 or now for $0. And if I were to market buy $10 million on any crypto exchange out there, obviously that would be a very poor decision due to slippage. But the fees would be insane. So you got dollar volume for very easy access of moving in and out of trades, which aligns with liquidity. And you've got opportunity with trading instruments. I can look to trade the S&P 500 by buying an ETF that tracks it tick for tick. I can also buy an ETF that magnifies the move of the S&P 500 300%. If the S&P 500 is going to move 1%, that ETF is going to move 3%. There's also one in the opposing direction. If the S&P 500 moves up 1%, that ETF is going to move down 3%. So I can choose the amount of volatility I want, whether I want high risk and high reward or low risk and low reward. Aside from that, of course, we've got options. We've got leveraged ETFs that trade individual sectors, that trade commodities like gold or oil or natural gas. It is just a plethora of trading opportunity out there. Whereas in the cryptocurrency world at this point, pretty much, you can do some futures contracts and things like that, but it's pretty much you're either long or short, and you do have opportunity with some leverage, but this is just a much more simple way, in my opinion, to keep things very tick for tick correlated with the underlying assets that are being tracked by these trading instruments. Ease of taxes. So for taxes in the cryptocurrency world, and again, this is certainly something I've had experience with as well, trying to get all of your information, exported into a platform that can make sense of it all and tell you what your profit or loss is, how much you dollar volume trading for the year was, and then reporting that on your stocks. It's still tricky, and that's because the space is new and it's just less developed. Whereas with stocks, I trade with Fidelity. Fidelity just gives me a year-end report. I export that year-end report to either my accountant, or I can export it into one of the tax services, whether it's TurboTax or whatever, and it's bing, bang, boom, done. It's very, very simple, and it's simple for a reason. This has been happening for decades, and these companies know to make it simple at this point. And that leads to the next point, history. The stock market has been around for a very long time at this point. The cryptocurrency space has been around for maybe 10% of the time that the stock market world has been around for. That has a number of factors. Again, all of these brokers have had way more time to build their systems and to adapt to recent times and recent technology. Aside from that, with history, the S&P 500 and the stock market has only ever gone up, in the sense that we're at all-time highs right now, and it's just a lot more of a trusted vehicle by society as a whole. Now, I'm not saying that that's the way it should be, because I know I personally have a lot of trouble trusting financial institutions, the government, and this whole stock market game. But we can look at history, and that gives a lot of confidence to the general population to have that history to look back upon and see all the ways things have played out. We can look back at what stocks did during the Great Depression. We can't really look at what Bitcoin or the cryptocurrency space has done with a major war taking place or something along those lines. So that's also a factor in the sense that, you can say the same thing. Yeah, Bitcoin's only ever gone up as well if you look back at the history. But keep in mind that, for a 20 to 30-year-old to put their capital in an instrument that has insane volatile swings is way different than looking for a 50 or 60-year-old to risk retirement funds with those kinds of drawdowns and pullbacks. And it's just not the same thing. So again, having that history as a bit of stability in the grand scheme of things is a benefit to a lot of people when they look to put their money in something that they want to feel like they can trust. Not 24/7, so this is something I put in parentheses because it's a benefit for some people and it's a negative for some people. So it would be a benefit for someone who maybe has working hours that interfere with the stock trading day. It is a benefit to someone that maybe is on a different time zone that does not line up with the stock trading day of 9:30 a.m. Eastern to 4 p.m. Eastern. It's also, it's the kind of thing where when I first started trading cryptocurrency, it was great. There was a huge opportunity out there, and I had 24/7 to be able to smash that opportunity with as much effort as I wanted to put in time. Then, after about 7 months of doing that, I said to myself, man, I can't wait till the top is hit, because this is very unsustainable as far as sleep schedule goes, as far as keeping my sanity of staring at the screen 12 hours a day or however long. So for some people, it'll be a benefit that trading stops and you can stop looking at the computer. And for others who have different circumstances, it will be the potential of a downside. Now let's go over some of the cons of trading stocks versus cryptocurrency. The first, and probably the biggest, is gaps. People in the cryptocurrency world are not used to gaps. There are gaps in the Bitcoin futures contracts. There's maybe some gaps on some small altcoins that don't have a lot of liquidity, but on things that are liquid, whether it's Bitcoin or Ethereum or Litecoin, there's not really any gaps because of the 24/7 trading. What creates a gap in stocks is the fact that we stop trading. So if I have Netflix, and Netflix closes the day near the high of the day at $370. I'm in a trade and my stop loss is at $367. We then see Disney after hours at 5 p.m. Eastern put out news that they are offering a free month trial to everybody to try their service. Netflix is going to respond negatively to that because that's their competition making a move. So if Netflix opens the next morning when the bell rings at $365, my stop loss just got skipped and the risk of the trade is more than I had anticipated. So obviously managing our risk in trades is extremely important. This is a big factor why I day trade 95% of the time versus what I will swing trade, because of the amount of times where just news after hours would ruin a trade setup that had nothing to do with the technical analysis setup. So you also have an environment now where the president is putting out tweets that significantly move the market before and after hours. You have China putting out news in the middle of the night that affects markets. So it's definitely a variable that is at risk of having bigger losses than anticipated. And the best way to avoid it is to stick to day trading. And obviously not everybody can do that. The next is margin requirements. So what are margin requirements? What is settlement? What is the pattern day trader rule? So those are all three negatives for some people, and we will go over those more in depth in some future slides here in just a bit. And then, like I said, the time zone conflict. And you see it in the US, the West Coast of the US, the stock market opens at 6:30 a.m. So if I want to be prepared and get ready for the morning, I need to wake up at 4:30 or 5 a.m. if I were keeping the same routine that I personally have right now. On the East Coast of the US, it's definitely what was the time zone was designed because the New York Stock Exchange is on the East Coast here. But if you're in Europe or Australia or even Hawaii, you're going to be dealing with some very difficult hours of when the market is open, and that may limit your opportunity. So now looking at the similarities between stocks and crypto, the first and biggest is opportunities in cycles. We've certainly seen that exemplified at this point, but there are times where we see big spikes in volatility and volume, and there's times where ranges tighten up and that volume and volatility drops off. As traders, we want to be where there's high volatility and high volume, because if there's a trading instrument that's making a 10% move in one day, we don't have to nail that entire move, but trying to scalp 2 to 4% in a 10% move sure beats trying to scalp 2 to 4% in a 4% move or even less. So being able to recognize when equilibriums are forming and ranges and volumes are tightening up, when we're breaking those tightening ranges, just off the top of my head, we had the gold market trade for 2 years in a monthly equilibrium. It broke bullish, and it was the most opportunity that we've seen in precious metals in that 2-year span, pretty much. So being able to recognize that break was coming is something that we can do with technical analysis. We can't say exactly when it's going to be happening, but we can certainly prepare ourselves and say, it's time to start paying attention for when this break takes place. And again, being able to maneuver to areas where there is high volume and volatility, and to be able to maneuver away from spaces that have low volume and low volatility is going to be essential if we're going to try and keep opportunity in our favors. Bots, algos, tweets, and news. So we've certainly seen this in both spaces. We know the bots and the algos are always trading. It's become a lot more clear in the cryptocurrency space that they are prevalent when we have very low volume. Retail trading is not dictating price action, and we're just seeing the bots give us those BART patterns where we have the big spike up, we trade sideways, and then the big spike down. And it's clear that those are just bots trading with each other back and forth, and it's not really a favorable environment to trade in. Tweets and news. So whether it's a tweet about China FUD or India FUD that leads to a drop in Bitcoin, a news release out of either of those countries or wherever, we certainly see the bots and the algos react to headlines. It is very much the case in the stock market world that happens as well. We see Trump put out a tweet and the market is instantly reacting. We see a China headline overnight and the futures market is instantly reacting, and that's going to impact how the stock market is going to open the following day. So it's very imperative to be on top of news and tweets, just because they give us big spikes in volatility and big volume when it is meaningful news or tweets that are coming out. Manipulation, I've said it once, I'll say it again. If there is big money involved, whatever it is, there is manipulation going on. So we have to accept that. Yes, Bitcoin is manipulated. Yes, the stock market is manipulated. Yes, the gold trading floor is manipulated. We've got the NBA manipulated by refs that are getting paid and gambling. We've got everything that you can imagine where there is money involved, politics, whatever, there is manipulation. It is human nature to be greedy and to manipulate and break rules. So we just have to accept that fact and hopefully rise above that in ourselves and be able to overcome that. Perhaps it's a basic instinct from back when we were cavemen, whatever the reason. We certainly don't want to be doing that ourselves, but we have to anticipate that that is going to be going on in the space, and we have to be aware of that and accept that. It's part of the game. If we want to play this game and try and make money playing this game, manipulation is part of this game. And of course, lastly, time commitment required to trade consistently. It's the same. We can't anticipate, oh, this market is way easier than this market. Some people find other markets much easier than other markets, but that is not the case in terms of saying, well, stocks are going to be so much easier. I'm going to be able to consistently make profits so much faster. We obviously have to put in the time and the education and the dedication with whatever we're trying to trade. And the good news is the lessons and the education that we get from one market can absolutely be transferred over into another one. The only reason that I personally was able to do so well in the cryptocurrency space in 2017, and most importantly, not give my profit back once the all-time high was hit and the pullback started, the reason was I had experience and I was very confident in my technical analysis, and that technical analysis was applied into the cryptocurrency space very seamlessly. Just like if you are a trader in the cryptocurrency space and you're very confident in yourself, you will be able to transition to the stock world. Absolutely. You might have to make some tweaks and some little changes, but you will definitely be able to apply the same lessons in technical analysis and trading that you got in the cryptocurrency space to the stock market world. So in trading the stock world, there are certainly some fundamentals that we need to be keeping an eye on as they have impact on the stocks. We see the algos and the bots, and traders react to information very quickly when things come out. And being a chart guy, I'm very interested in the technicals, much less in the fundamentals, but that does not mean that I completely ignore the fundamentals, because we have to be paying attention to this stuff. So the first is the FOMC meetings. And again, this video is meant to give you information to continue your own further research outside of this video. I'm not going to tell you everything you need to know in this video, so I'm not going to go very in-depth to the FOMC, but this is an example of something you would write down in your notebook that you're holding in your hands as I speak, and then you would further Google this information on your own to learn more about it, more in-depth. So the FOMC meetings, there were 8 in 2019, and they are a place where the Fed sets broader macroeconomic it sets rates essentially, and then it gives outlook into the future as to what they expect to do further in the future. So when we get rate cuts, the market responds bullish, and when we get rate hikes, the market responds bearish. And that's a generalization, but that's normally what we see. The most important factor about the reaction that we're going to see in the FOMC is, what does the market expect? Market expectations are almost just as important as what the actual information that we get is. So an example is, a couple years ago, the FOMC meetings that we were getting, we had no idea what to be expecting. And the percentage odds of getting a rate hike or a cut or nothing happening was 50-50 or closer to it, 55-45. And that allows, that prevents the market from being able to accurately price in what we're going to see in advance. So when we would get the actual FOMC decisions released at 2 p.m. Eastern on those Wednesdays, it's always a Wednesday, it's always 2 p.m. Eastern, we would see pretty violent market reactions. Now, most recently, the market has been very certain about things, in the sense that the last one that we had, which was in October of 2019 here, it was a 95% chance that we were going to get a rate cut. So when we got the rate cut, the market didn't see a huge reaction, because the market knew that was what was coming. And in the times where we know what's coming, it's the forward-looking language that has more of an impact. So again, the more certain a reaction is, the less reaction we see when it actually happens. Now, of course, if we had a 95% chance of a rate cut and we did not get a rate cut, the market would have dumped in response to that because the market was counting on a rate cut, which it perceives as bullish. So these are things to be aware of, and there's a website, which I'll show you in just a minute, to look at the percentage odds as to what the market is anticipating the FOMC to do. Of course, earnings. So individual stocks have their individual earnings 4 times a year, every quarter, and we have an earnings season where there's about 3 or 4 weeks where all the major companies put out their earnings, and it's generally the financial sector comes first. Then we have the tech sector come after that. Netflix is usually the first tech sector name to give its earnings. And what Netflix earnings do have an impact short term on everybody else in the tech sector because the market is using the information, even though they could be completely different businesses, the market is using the information from the Netflix earnings to apply to what is more likely to happen with the other individual companies and their earnings. So if Netflix has a big beat and is up huge, in response to that, a 10% gap up the next day, you're going to see all of the tech sector respond and say, whoa, those were great earnings. We might be looking at beats on all these names to be happening. So it's important to be watching the earnings. How do I play earnings? I don't. I do not trade earnings because, in my opinion, unless you are putting in dozens and dozens and dozens of hours as a fundamental analyst, reading financial statements of competitors, there are people out there where this is their full-time job and they definitely have an edge on the market as far as knowing what the fundamentals or the reaction to earnings will be. I certainly don't think that your average run-of-the-mill analyst that's giving upgrades and downgrades on stocks really fit into that category, but that's another story. So unless you're doing that, you don't have an edge on earnings. And if you're playing earnings, you're guessing and you're gambling and you're flipping a coin as to whether it's a bullish or bearish reaction. And a lot of people can do that and realize they're gambling and allocate a small amount of capital. And that's fine if you enjoy doing it. And as long as you know you're not going broke doing it. But for me, I know that I'd be kidding myself if I were playing earnings and thinking that I had any insight as far as shifting the odds in my favor of what the most likely reaction is going to be. So what do? I play pre-earnings and post-earnings. So pre-earnings, the only play that I will make is if we see a name extremely extended in one direction for a week plus heading into those earnings. Let's just use an example. If Netflix has been running up and is up 6% in the last 5 trading days. And it's very overextended with high RSI levels. And that tells us bulls are confident heading into earnings. But what I will do is I'll wait for the day where earnings are going to come out after hours. And if the bulls start off that day strong, I will look for profit taking. And I will say, okay, the bulls are up significantly heading into an unknown event. They're going to lock in some profit. Bears are viewing it as a potential discount. A bear can say, hey, we've run 5% in the last 6% in the last 5 trading days. I don't think we're going to see much further upside on a reaction to earnings, so I'm going to go bearish. So we look for that short-term end of the day action to equalize things out a bit. And likewise, if we're dumping hard into earnings, you're going to see shorts cover before earnings, and you're going to see some bulls view it as a discount heading into earnings. So I look at that opposite of the trend play for just short-term trading, a little day trade. And otherwise, I will play after earnings when we get a ton of volatility. And generally, when we see spikes of volatility in new trading ranges, that's when we see equilibriums form. So I'll look for, a big sell-off on reaction to earnings. And then the next morning, if we get a bounce and the hourly time frame is cooling off RSI levels, I'll be looking for that hourly lower high to make an entry, anticipating that an equilibrium is the most likely scenario. Sometimes that certainly does not play out, but more often than not, equilibriums are what result from significant reactions to earnings, at least in shorter term timeframes, whether it's the hourly or even the daily time frame can potentially give us some equilibriums after earnings. Commodity inventory reports. These essentially, I view these as pretty much the earnings report for commodities, whether it is oil or natural gas. Those are the 2 most common that we look at, and those happen every week. And oil is Wednesday at 10:30 a.m. Eastern, and natural gas is Thursday, 10:30 a.m. Eastern. And I'll be completely honest with you, I have never read an oil or natural gas inventory report in my life. And I trade oil and natural gas all the time. I do not hold through those inventory reports. Again, I will do it the same way where if we're crushed heading to the inventory report, what I will do is, let's say oil is extremely oversold and at potentially even historical RSI bounce levels, and we see an initial bearish reaction to the inventory report. I am much more inclined to buy that dip, knowing the bears are so exhausted that we may just be seeing that initial quick flush down before an oversold bounce gets going. We've seen that play out many times before. And likewise in the other direction, if we're extremely overbought and we have a bullish reaction to the inventory report, we'll be looking for the potential of consolidation in the very near term because the bulls use up all their buying power in the first 5 minutes in response to that inventory report. So again, Google inventory report, learn about that if you're trading commodities. Economic data, we get jobs reports, we get GDP numbers. So it's important every morning, part of my whiteboard routine. And if you haven't seen it already, check out my routine of a day trader video on our YouTube channel. But I look at the economic events for that day. There's economic calendars all over the place. You could just Google it and find it every day just to be aware of what's coming up. We have manufacturing numbers that sometimes at 10 a.m. in the day can give us a spike in volume and volatility. And sometimes I forget, I'll look at that and I'll know that there's some data coming out in the morning and I'll be in the thick of trading and I'll see a spike in volume on the S&P 500 and a pickup in volatility. And I'll say, oh, what was that news? And then I look and say, oh yeah, that was the manufacturing numbers that just came out. So they are important to keep in mind because we do see them reflected on the charts as far as reactions. IPOs. So IPOs, probably the clearest example of those in the know that know this game of trading stocks, taking money from those that are not in the know and do not have control of their emotions. And BYND is a perfect example of that. And we will look at that now as we head into some charts. So first, let's go over IPOs. This is BYND, which was all the rage here in the second half of 2019 as the hottest IPO. And its media has a big part to play in this. So what do I mean by the largest transfer from those in the know to those that do not know how to play this game? You see those in the know run the price up and get emotions involved. Hype and emotion is those in the know's best friend because those who do not know what they're doing and the herd are very susceptible to that. And you better believe that there are people that bought this company from $150 to $200 and they are still holding it down at $82. So we see this happen time and time again where companies run huge on after IPOs. Why do we run huge? Number one, shares are not available to short for IPOs, at least to get going. Number two, we have banks and insiders that have big money in these names already and they want to sell onto the herd. And we have the media playing a part in it as well. The amount of times BYND was talked about in the media and the amount of articles we saw on it was very clear, and we see it every time. That's what happens. The media is part of the pump. And a third is market makers do not have established positions with recent IPOs. The reason being, what a market maker does is accumulates huge amounts of shares to be able to dish them out on the bid and the ask, and they make their money by the incremental little scalpings. They'll sell a bunch at 100 and they'll buy a bunch back at 99.90, and they're just scalping those cents, and it definitely makes it worthwhile for them after a while. But they don't have the large positions to dictate liquidity in stocks when we just start trading. A lot of the run-up is market makers initiating their big positions as well. So recent IPOs, also the lack of price history. You're in Black Dirt Breakdown or Blue Sky Breakout after day one or on day one. So there is a lack of price history as well. Things just move very easily. They are very high risk and high reward versus already established stocks. So you can see that BYND ran from $40 to $60 as we started and then just exploded up to $239. So multiple hundreds of percent gains in a very short amount of time in regards to the stock market, maybe 2 months. And then we pulled back. And now we are down at $82 without setting a bottom just yet. So again, this has played out time and time again. GoPro went from $30 to $98. And here we stand right now down in the single digits. So again, it's just those in the know, just the amount of times that GoPro was on CNBC and the holiday shopping hype. And here we are just in the dirt, down 90+%. And retail and the herd is left holding the bag. Everybody that knows the game of stocks was selling GoPro up at these very inflated levels. So again, just something you want to be aware of. If you see it's a recent IPO, it's risky. And if you're from the cryptocurrency space, there is generally less volatility. Apple moving 1 or 2% is a big day. And if you're used to seeing names moving 5% to 20% in a big day, then you might be a little bit bored with some of the bigger stocks. IPOs will have your volatility. Just be aware the risk that comes with the potential reward. Oil. So this is an example of the inventory report, the biggest range on the 5-minute candlestick. This is Wednesday of inventory report day. You can see the biggest range is in reaction to that inventory report coming out. And this is the kind of move that can stop you out in either direction before going in the opposite direction. And that happens on the FOMC and these reports that come out midday, which is why I don't like holding positions. It's way too easy. If you're mitigating risk as you should be as a good trader with stop losses in place, you're going to get stopped out and faked out often on these plays. So I prefer to just skip that, not have a position, and then look to play after the reaction takes place. So looking at just a quick example, let's look at we'll leave it here, but oil, the range set in the first 5-minute candlestick. We then see the bulls making their move back up. If you want to be bearish oil after that, you're top fishing this little resistance at 55.34, 55.32, and you're going bearish and putting a stop above that level, and it would have ended up following through. So you can play the ranges. Like I said, you get the range established after the reaction to play off of, and I prefer that much more than playing the reaction itself. Last, we'll look at Netflix. So Netflix earnings. How can we play after earnings? So this is the earnings reaction after hours one day. We rock it up on bullish action. We then trade sideways all extended hours. And we're building a base of support in the 307s. 306.58 is the low of consolidation at that point. And actually it's 306.23 right here. So how we would use this information, we have the low of trading of the entire period since the reaction to earnings down at this level. And we can say, okay, well, if we break that level, we don't have any support immediately nearby. We shot up and did not establish support on the way up. So as soon as those low 306s break, there is no nearby support. We're looking towards 3 psychological, which is 2% away. So you can see first thing, right into the morning, we broke those supports. The first 5-minute candlestick, the bulls tried to save it. As soon as we hit that new low of the day, we were in an area with 0 support, and the price went from the low of the day then was 302.45 all the way down to 288.30 in less than an hour. That's a huge pullback. And again, even if you're not nailing that whole move, that was an opportunity for 4.6%. And if you nailed a quarter of that move, there's your 1% move on the day. Certainly very worthwhile. So again, the ranges that are established in response to these events can be used to trade off of. I just recorded this slide about brokers by unintentionally blocking off the bottom 2 bullet points. So give them a quick read here and I will talk about them in just a second. So now let's talk about brokers. Brokers are the equivalent of exchanges from the cryptocurrency world. They're all very different. They have different user experiences, different platforms for their trading, different customer service experiences. All of that are factors as to what is the best fit for you. The US has probably the most options as who we can choose for brokers. If you're outside of the US, it's a bit more limited. But in the US, the most common that we see in the chat room are Fidelity, TDA, TD Ameritrade, Thinkorswim. Those are all the same thing. And Interactive Brokers, a lot of people refer to it as IB. Those are the 3 that are most common. I have been with Fidelity for now pushing on 10 years. I just haven't had a real convincing reason to get me to switch. Their customer service has been on point. I chat with the representative I have over 100 times where I just hop on, get a quick answer to my question, and it's very straightforward and simple. And I like their trading platform. Active Trader Pro is something I've been using for maybe 6+ years. And I like it. So I'm comfortable there. I will switch. You know, Fidelity was close to having me switch where all the other brokers went to 0 fees and Fidelity took about a week to follow through. So I said, all right, well, if this week they don't go to 0, I'm going to move. And they did go to 0 that week. So they kept me around for now. I will change if it dictates, but it hasn't yet. So I've been very satisfied there. TD Ameritrade, a lot of people like it. A lot of people like their Thinkorswim platform. Their paper trading platform is certainly better than most brokers out there. Interactive Brokers has a lot of shares available to short for companies that other brokers don't. So the brokers are providing the shares to short for you. So for example, the Canadian marijuana space, Fidelity right now only has Cron shares available to short and doesn't have shorts available for another 6 names, whereas Interactive Brokers has shares to short for all of those names. So if I were looking to be actively trading that sector short, which in hindsight I should have done, and that would have been a good reason to switch brokers back then, but that would be a reason to switch your broker. Interactive Brokers is also the standard for outside of the US. and it's the most common. It has the biggest reach as far as target market and countries that they do service. But again, you have to get on Google and do some research and compare reviews of brokers that are available in your country. And it's going to take a little bit of research and a little bit of comparison for you to find the right fit. Platform fees, customer service, availability for shorts. Again, these are the things that make up the decisions on what you want to take. I don't like the charting software on any of these brokers. I like TradingView. So Fidelity has charts, and I'll keep a chart up on my screen from Fidelity during the trading day that I will keep an eye on. But if I want to do any detailed, interactive charting, I'm using TradingView. So TradingView is still leaps and bounds ahead of what these brokers are using for their charting service, in my opinion. And that's why having multiple screens can help. I've got my Fidelity Active Trader Pro on one screen. I've got TradingView on another screen. And if I want to quickly cycle in between time frames and zoom in and zoom out, it's TradingView that I'm going to be using. As far as funding these brokers, it's as easy for the most part as connecting your bank account and then just being able to deposit and withdraw between that bank account. You can also transfer shares from one broker. If you have a broker and you want to switch, you can transfer positions from one to the other. There's a lot of maneuverability, but for the most part, going through a bank is the standard, easiest way. And of course, a lot of crypto people aren't going to like that fact. And again, crypto is very eye-opening for me with this. The fact that if I want to withdraw money, it takes multiple days. The fact that if it's over a weekend, it's going to take maybe 4 or 5 days. That definitely makes the current system dealing with banks and dealing with US dollars seem archaic comparative to the cryptocurrency space where you're moving money anytime, 365 days a year, and it just takes maybe a couple hours at most. So eventually, in my opinion, we will absolutely see that trickle down to the space where we are seeing much more instantaneous movement of funds, but that's going to be something that's going to be frustrating for a lot of crypto traders moving into this space. So do your own research, get on Google, and choose what is best for you. So for the next handful of slides in this video, it's the kind of thing where if this were a class, your eyes would start to get a little bit heavy and it's a little bit harder to pay attention. The reason being it's a bit of a dense subject. This is also the kind of thing that you should not expect to understand fully from watching this video once. This is the kind of thing where you're going to go forward and do your own research, read articles about these concepts, watch little videos about these concepts, and revisit them multiple times. I personally have read about these concepts a dozen times, and every few years I'll read about them again to refresh my memory as to exactly what the details do entail. So we're going to look at settlement, margin, pattern day trading, and trader tax status. These are all things that have to do with the stock trading world. We're going to talk about what they are, how we can potentially work around some of them, and what are the consequences if we do break the rules that the brokers have already established. And I personally have done that in my past. And again, biggest takeaway, further research will be required to fully grasp these concepts. So the first concept we're going to look at here is settlement. And settlement is, again, going back to the Stone Age as far as cryptocurrency traders are concerned, because what it is the deal actually following through and being official as far as the trade. So in cryptocurrency, when I buy Bitcoin, someone's getting my dollars and I'm getting their Bitcoin instantaneously. The deal is done. With stocks, it's not that way. With stocks, I buy, and it takes 2 days for those shares to physically end up in my account. Now, the brokers will put those shares in my account as soon as I buy them, but they're not officially there until 2 days after. And again, it goes back to taking multiple business days to move money from a bank to a broker. This is the same thing. It takes multiple business days for this settlement to occur. That being said, we are seeing the slow shift. Just like we saw fees continuously drop in the brokers, we saw settlement shrink. So settlement used to be the day of the transaction plus 3 business days until things are officially settled. And in 2017, they changed it and knocked off a day. So hopefully, as we continue to progress in technology, we will see that drop down to eventually being instantaneous in the sense that when I buy and sell, it is taking place right then and there. Options settle the next day. So they have a shorter settlement time, and that is beneficial. So why does settlement matter? It matters because if I am buying something and selling something and then rebuying it, let's say I'm day trading. So I buy a stock, Apple, and then I sell it and then I rebuy it all in the same day. I'm technically buying and selling something that I don't officially own because it's not settled in my account. That's when brokers start to get upset with you if you are not on margin and if you do not have $25,000 to qualify as a pattern day trader. So we'll go into those concepts a little bit more, but that's why settlement is important. And that's one way to work around it. Of course, options are very difficult. Again, I traded and used charts and technical analysis for 4 years before I tried options. And then I lost money when I first started trading options. I thought, oh, I got this down. I can do this. It's a completely different animal. So again, if you're going to look into options as a way to work around having a smaller account, it's a great way to do so in the sense that you can use a little bit of capital and go a long way. Again, I was using it as an experiment as I got comfortable with trading while live streaming, and using smaller capital, I was able to trade $2,000 to $4,000 positions and go, 50 to 100% 4 months in a row while I was doing that. So it's easy to make a lot of money and lose a lot of money real quick, which is why people like options. But just be aware that you need to put in a whole bunch of time to understand how options work if you're going to try and do this. But if you are going to trade options and you have a cash account, that's when you can day trade and you can buy and sell and it will get settled the next day. So if I have $10,000 and I can buy and sell up to $10,000 that day, and then the next day that $10,000 will be ready to go again. Now, if I have a margin account, I can still be subject to pattern day trading and I would still need to have $25,000. So again, we'll learn a little bit more about pattern day trading in just a second, but what's important to take away from this slide is settlement takes 2 business days. Options with a cash account can settle the next day, so I can day trade the amount of cash that I have in my account day after day, as long as I don't trade more than I have. And if I am using margin for trading options, I am still subject to the pattern day trading rule, and I do need $25,000 as a minimum in my account to be able to do that. So now let's clarify the difference between a margin and a cash account. I can have an individual brokerage account that is margin or cash, and the differences are basically in what you're allowed to do with them. So if I have a cash account, I am only trading with the money that I have. I am not relying on the broker to lend me anything. So if I have $10,000 and I want to buy $10,000 of Apple, I buy and sell, and from the point when I sell, it takes 2 business days before that cash is settled back in my account to allow me to trade with yet again. If I have a margin account, that's when I'm borrowing things from the broker. So if I want to short, I have to have a margin account, because shorting shares by definition is borrowing those shares that I have not bought. I'm borrowing them from the broker and I'm selling them into the market. Just like when you're shorting cryptocurrency, you're borrowing Bitcoin or whatever from the exchange and you are selling it into the market. So that's why if I want to be a full-time day trader, I have to have $25,000. That's a law. That's not set by the brokers. The brokers set their minimum for margin requirements. The New York Stock Exchange and NASDAQ require $2,000, but brokers have their own individual levels. As far as the pattern day trader, which again, we'll talk about in just a second, I need $25,000, and that's a law. It's not determined by the brokers. It's determined by the government. And a lot of people don't like that because the government is putting limitations on pretty much telling you what you can do with your money. But all that aside, if I have a margin account, I can be lent more money than I have in my cash. But that's also why I'm able to buy and sell in the same day repeatedly, because the broker is saying, okay, we will loan you this money to be able to do that. Even though your money is not going to be settled for 2 days in your account, we can see that you have enough capital that we're willing to take on this risk of loaning you some money. And that's why you're able to buy and sell repeatedly all day, even though the settlement doesn't take place till 2 days later. It's pretty much the broker saying, all right, we'll spot you until the settlement actually goes through. So to keep it simple, if I am in a cash account, I am trading with only what I have, and that is my limitation. If I'm in a margin account, I can short shares. I can buy long positions for more cash than I have in my account. How much more will depend on what the individual broker is willing to give you based on the amount of cash that you do have. And those are the 2 most distinct differences between a cash account and a margin account. So here we are, pattern day trader, the arch nemesis of anybody trying to day trade stocks that does not have $25,000 in their account. A pattern day trader is a regulatory designation for traders or investors that execute 4 or more day trades during a 5 business day rolling period in a margin account. So I'm just a regular old trader, but as soon as I have those 4 day trades in a 5-day period, I am now a pattern day trader. And that means that I have to have $25,000 in my account, in my margin account, to be able to continue with my day trading activities. Again, it is a regulatory hurdle that is placed there that a lot of people don't like, and it's going to be the biggest hurdle for a lot of crypto traders that don't have $25,000 to move to the stock space. I have the picture here as a jail cell because I personally have been put in timeout by Fidelity multiple times in my 10 years of trading because of this rule. I can literally remember where I was standing and what I was doing when I received a message from Fidelity 10 years ago telling me that I had broken this rule. And that's when I essentially went on the computer and started to read all about it because I was unaware of it at that time. So there's some people that trade right around that $25,000 mark, and it's a bit of a balancing act to try and ensure that you stay over that mark, because if you fall underneath it, then you no longer have the liberty of being able to day trade. So it's the minimum of $25,000. If you receive a margin call, what Fidelity has is something called a good faith violation, where if I buy and sell something before the settlement takes place, they give me a strike and they say, hey, you did this, you're not supposed to be doing this. And if I get 3 strikes, they put me in a 90-day timeout. Now, when that 90-day timeout hits, I personally used to use it to my advantage in the sense that I would become very picky about the trades that I took. I would practice swing trading more. I would use that time that I was trading less to focus on my education more. Some people, they'll just move their funds to a different broker and do it all over again. That's obviously an option as well. It's a little bit more effort than I was willing to put up with. So I would just take it as an indication that I need to slow down, only trade with the cash that I have, and tried to spin it to use it to my advantage to a certain degree. But what a margin call is essentially the broker saying, hey, you've been buying and selling more than your account has in value, and the settlement has not hit yet, and you need to have this many dollars in your account by this date to meet this margin call. If you are unable to do that, then you're going to get your 90-day restriction where you can only trade cash. So again, if I have a cash account and I'm buying and selling, it's going to not allow me to place any more trades once I've used up all the cash and I'm waiting for stuff to settle. If I have a margin account, it is going to allow me to keep buying and selling, and it doesn't really give you that heads up. It's something you have to track by yourself, and that's something that was a bit frustrating for me, trying to keep track of, how many day trades have I had, how many days has it been, when is the settlement, and it's a lot easier that the cash account just literally won't let you trade when you don't have those funds available. So it is something you have to be aware of. And getting over that $25,000 hurdle is a game changer for those who are confident with day trading and successful in terms of using that as a strategy. But again, this is probably the biggest hurdle that a crypto trader is going to have getting into the stock world, wanting to day trade, getting over the $25,000 requirement. So the last concept that we're going to be looking at here is trader tax status. And of course, this is something you want to consult a professional about. And I am not a professional, just trying to guide you in a certain direction to research this a bit more. So I was fortunate enough to have one of our TheChartGuys members also be a CPA. And I cannot stress the importance where if you are a trader, having your accountant be a trader as well is priceless. So I was planning on paying X dollars in 2018 in my taxes, and after being converted to trader tax status and applying that to 2018 and 2017, I received back from the government 4 times what I was planning on paying. That's obviously a huge difference and a big bonus that I was not expecting. So what this does is it possibly unlocks business expense treatment. So you can write things off. If you trade in one room in your house and that's the only room that you trade in, that's all you do in that room, you can potentially use that as a write-off. You can write off expenses, whether it's, your subscription to TradingView or whatever else. Those can be treated as business expenses, and you're exempt from wash sale loss adjustment. And that was the game changer for me. And a wash sale is when you are holding something and you sell it at a loss and then you buy it back. And the way that the IRS is going to treat that, they're going to say, no, you can't do that, because otherwise people would just be locking in those losses and then rebuying the exact same position and pretty much shaping how their taxes are going to look by that little maneuver. So if you have trader tax status, that wash sale adjustment does not apply to you. And again, that's a big difference because I'm viewing things as a day trader as just incrementally a win or a loss every single time. Whereas if I sell at a loss and then rebuy that position a week later, I would not be able to apply that loss to my end of year taxes. So it's very subjective as far as what the qualifications are, which is again, why you want to consult a professional. This is not cut and dry, yes or no. It is dependent on typical holding periods of securities that you buy and sell, the frequency you trade and the amount of dollar volume you're moving around, the extent to which you pursue the activity to produce income for a livelihood, and the amount of time you devote to the activity. These are all the most important factors to determine whether or not you qualify. Pretty much it's determining, do you do this for a living or not? And if you do it for a living, there are some benefits that you can see. So I definitely suggest if you are a full-time trader to look into this because hopefully it can be a game changer for you as well. So how do gaps impact charts and technical analysis? So first things first, a general rule of thumb is gap ups are for selling, gap downs are for buying. Obviously, there's going to be plenty of examples where the opposite is true in both scenarios, but if you give me a blank statement, don't tell me anything about the chart or anything about the news, and you give me an option, are you going to buy this gap up or sell this gap up? I'm going to say I'm going to sell this gap up, and that's just from watching it 1,000 times and seeing what the most likely scenario is. So this is a chart for CGC. This is back when hype was really strong. And look at just this couple month time span. And it got so easy to make this play that everybody was doing it. Look how many gap ups we have for selling. So we gap up and close lower. That's 1, 2, 3, 4. There's another one in there, 5, 6. It just happened very often. Look at the gap downs for buying where we closed higher. 1, 2, 3, 4, you get the idea. There's just plenty of examples of both where we end up pulling back if we see a gap up open and vice versa if we gap down open. And that's just because there's an imbalance. We skip a lot of the order book and people lock in profit when you give them unexpected profit and a gap up open very quickly, and people look to buy dips when you see the gap down. So there's another thing to know about gaps, and when we are in a gap, there is a lack of support and resistance, depending on which direction you're going. So this is Roku on the daily time frame. It's also been a fairly hyped stock, but we want to look at the support level right here. And this is a key level down at 117.56 because when this breaks, there is no support in this area as far as previous price action until we get to the gap fill at 103.84. The gap fills at the high of that candlestick, which means there's no more space where there hasn't been price action. So look at the day where we broke that support and then just absolutely fell right through that level on huge bear volume and filled that gap very quickly. That gap filled by about 20 cents and then saw a tiny little bounce at the end of the day from that. And actually, it wasn't a tiny bounce. That was a 4% bounce from that gap fill. So they're targets. Let's look at the other way, where on the way back up, we had a gap down on earnings. The bulls broke the top of that earnings reaction, and then there is no resistance until the gap fill at 136.81. So they're targets. Do all gaps fill? No. Do most gaps fill? Yes. There's gaps right now on Netflix from double digits, and here we are trading in the $300 range. Those are probably not going to fill unless the company gets in a whole bunch of trouble. So don't assume they're automatically going to fill. There's no time frame on when they're going to fill. But if we get over a certain level, we use them as the next target. We say, okay, we're over 128.38. The next target we're looking up towards is 136.81, and the bulls will have an easier time going through that area where there is no previous price action than they would if there were little lower highs and lower lows on the hourly time frame pulling back down there. So the advice that I would give to somebody with the small account trading options is don't for a while. And that means a bunch of education. I'm talking 100+ hours of observation and studying. I'm talking paper trading for a month at a bare minimum. And that is because if you asked me what is the quickest way for someone to blow up their account, I would say trade options, go for it. because you will be astounded at how quickly these percentage moves go up and down on weekly options that move faster and even on options that expire further out. So it is not the same thing as trading a stock or a cryptocurrency. It is a completely different trading instrument, which means it's a completely different animal. And I guarantee there's going to be a lot of things that surprise you about how the price of these options moves comparative to how the price of the stock is moving. Can it be done? Yes, absolutely, with tons of diligence and education and studying, but have to preserve capital, because if you just start trying to trade, again, you're going to lose a lot of money really quickly, in my opinion. I have to be as blunt as possible. Don't do it until you are proving to yourself. I understand after a month of watching daily, and if you can't watch every day, then you're going to look 2-3 months out. That's the amount of time that is required to understand how options are going to be trading. So I go over this a little bit in the My Morning Routine video where I talk about the different sectors that I watch, but the most important things to be watching to get the overall gauge of what the market is doing, for me, it's the S&P 500. Why don't I care about the Dow? CNBC is talking about the Dow all the time. The Dow is 30 companies, and when one individual company has news, like Nike, let's say Nike has a big beat on earnings or bearish news, it's going to drag down the Dow significantly because it's 1/30th, and the holdings make up a little bit different size, but it's a big impact. Whereas the S&P 500 is 500 companies. So it's a much broader gauge of overall market strength. So every single day I'm watching what SPY is doing, and the biggest sectors affecting SPY, you've got the tech sector as number 1, the financial sector and bank stocks as number 2, and the healthcare sector as number 3. So I take number 1 and 2 as the most important. I'm watching the tech sector and the financial sector all day long, tick for tick. I know that when we see both the tech and financial sector going in the same direction, we're going to have some conviction in that direction for the overall market. If one's going up and one's going down, it might be a little bit more of a choppy day. If they're both going up, it's a strong day. If they're both going down, it's a weak day. And knowing what the overall market is doing is knowing the direction of the wind. And we want the wind at our backs. Yes, individual names can completely disregard what the market is doing, but we know that with high frequency trading and bots and algos, the correlations are all over the place. And if we see strength in the market and I'm trying to play bearish, I'm going to be going into the wind. Whereas if I see strength in the market and I'm playing bullish, I'm going to have the wind at my back. And that's what I always want to see. My ideal scenario is playing Netflix bullish. It's in the tech sector. I want to see QQQ bullish, which is the tech sector. I want to see SPY bullish. If I have all those 3 things bullish, I have all things going in my favor. How does the order book compare to level 2? So they're very similar. They're pretty much the same thing. Level 2 is going to show you where the market makers are, where the orders are, the size of the orders. Keep in mind they can be hidden. There's hidden orders all over the place on the bid and on the ask. So it's not a complete picture as to what's going on, but you can get some insight from it. For me, I use level 2. And it should be included with your broker, and maybe there's an additional fee depending on your broker. With Fidelity, it's included, but I use it on lower volume names. And that's because an order of $100,000 or $1 million on a company that's trading $20 million in a day is going to be way more significant than on a company that's trading $1 billion a day. So I'm going to be using it for penny stocks. I used it a lot when I traded penny stocks. I would use it for the MJ sector, which has lower market caps and less volume. But on names like Apple and Netflix and Google and all these monsters that are trading huge dollar volume, things are moving so fast that I don't use level 2 when I am day trading those names. So maybe you will find it insightful and useful. You can see orders where there's a little bit of a wall of resistance, a little bit of wall of support. I know we have a bunch of members in the futures trading world that use level 2 to see where there's walls of support and resistance. But just for me personally, when I'm trading the big board stocks, I am not looking at level 2. Doesn't mean you shouldn't. Explore it. See if it helps you. See if it's useful. I just know that for me personally, there's many instances where it's not useful. So you can trade stocks without fundamental analysis, but you can trade stocks better with fundamental analysis. So there's things you want to be knowing what's going on. You want to know what the herd is being fed by CNBC. You want to know what the market is waiting on. We have the Trump China-US trade deal that is getting all the headlines. We're in a market that's at all-time highs, and every time we get a bullish headline, it's just another push higher. If we were to suddenly get news from China saying, we're going to raise tariffs and we're not interested in a deal, the market would dump significantly because it's pricing in the deal going through. There's also individual things where, say Netflix has earnings, Facebook is going to react to how Netflix has earnings. They're in the same sector, the tech sector, and there will be correlations there. So there's plenty of instances where knowing what the fundamentals are going to give you a bit of an advantage. And there are plenty of times where you'll see a move spike out of nowhere based on something on Twitter or based on a headline coming out. So having your ear to the ground, and again, this is where having a team and a bunch of eyes on the market is invaluable to get up to the minute information as to why did we just see this huge volume spike, what's going on here. And a lot of the times we'll be able to see these algos and these bots reacting to headlines right when they come out. So you definitely want to be aware of what the fundamentals are. And if you're just getting into the stock world, you're going to be overwhelmed. What am I going to watch? There's all these sectors, all these stocks. Pick a few volatile names, get familiar with how they trade, get familiar with the news events that are going to be impacting them. Just Friday, we had XLV, where XLV had a bullish reaction to Trump talking about the healthcare sector. So XLV, this is the bull move, and it just exploded and just ran all day. And you can see the second half of the move here in the afternoon was just another big leg up. So definitely insightful to know what is going on in the fundamentals, because that can have a nice impact in your trading as well. So transitioning from crypto to stocks, in my opinion, is more difficult than transitioning from stocks to crypto. And that's just because there is a bit more that you have to wrap your head around. And this video talks about most of those things. So it takes a little bit more time and effort. It's certainly doable if you're willing to put that in and you have enough motivation. I personally had a very seamless transition from stocks to crypto. The technical analysis applied beautifully. All I had to do was read some articles and watch some videos to understand what it was that I was trading when I was just understanding what was this whole cryptocurrency Bitcoin thing about. But going from the stock world, as long as you are confident in your technical analysis, that's the hard part. So if you got the technical analysis down and you've proven yourself as a crypto trader, it will be fairly easy to transition to stocks. It'll just be a little bit of some growing pains along the way. And again, you'll learn from every little lesson where you'll maybe forget about the FOMC reaction and you'll see a big spike in volatility one fine Wednesday at 2 p.m. Eastern, and you'll say, oh yeah, forgot to pay attention to the FOMC. So again, as long as you learn from those lessons and don't repeat mistakes over and over again, there will be a learning curve, but it will not be nearly as steep as the learning curve for learning technical analysis and trading. So to wrap it up here, of course, further education is needed. If I went in depth into everything we talked about in this video, it would easily be over 4 hours long. So now the ball is in your court. Do you have the time and the dedication to continue this path of education and transition from being a crypto trader to being a stock trader? Things that I would look into, I've got a YouTube video on our Chart Guys channel, Morning Routine of a Day Trader. It's different than crypto. We have a set start and stop time, and we must ensure that we have healthy routines to allow us to continuously have successful results and be able to repeat those successful results. Google, YouTube, and articles, you might be looking at that and saying, yeah, no duh, but I guarantee there's a lot of people out there who do not utilize those resources as much as they could. And I know that for a fact based on the questions I get on YouTube videos that could easily be answered in 30 seconds on Google. So utilize those. Every concept that we just talked about. If you wrote down areas that you want some more information, hopefully you're taking notes. You can then go and read 2 articles and watch 2 videos on that subject and have that hammered home in your subconscious a lot more clearly. Peers, groups, and teams. Cannot stress enough the importance of this. It's a lonely world as a trader out there, as there are not many of us, so we're not really running into each other out in our regular going-ons in life, and that's where the internet comes into play and can connect us. So having people to bounce ideas off of, having a bunch of eyes on the market, pointing out news, pointing out setups, and it's just a revolving door of mutually beneficial information sharing when you can put together a group of people that have a very diverse background, a very diverse informational background in terms of what they have experience in, what their expertise is. You know, if you've got a CPA in your group and you've got a lawyer and you've got a doctor, they can offer insights into different sectors and different scenarios that can be very beneficial. So I wish you all the best on your journey. Feel free to ask questions on this video as long as they're not 30-second Google questions, and we will look to continue this path forward from trading crypto to trading stocks.